what is the major bottleneck that we have in the region?
Yeah, I think it's an evolution.
So, Youssef, you are one of the most admiring finance professionals in the region. Did anybody tell you that you are too young to take this decision?
Yeah, so to be honest, wasn't necessarily a well thought through decision, but it just worked out and was quite nice, so I kept on with it. No matter how much you believe in the company and in what it's trying to do, unless other people can be convinced and other people can come on board, you're not going to be able to drive it on your own.
So, Youssef, thanks to my podcast. Welcome to my podcast. And you are one of the most admiring finance professionals in the region.
So
And I think one of the youngest CFOs in NASDAQ before. I want to ask more about IPOs and other things, which is very new to the region. And the second, we don't have somebody here like somebody young as you took dare to go to NASDAQ and list the company, like startups in the region. Very few, or it's not there. So how do you see the whole, why a founder generally has to go for an IPO?
Yeah, so I think obviously IPO has a few advantages, right? Generally, so obviously one is it's a way to kind of get liquidity for your investors while still maintaining control and being able to drive the company, as opposed to kind of a full exit. From a branding perspective, obviously being a listed company, from an employer branding, ability to get talent, if you're in a B2B business or a B2C business, it's just the brand you create with your consumers is quite nice. Obviously, you've got this ongoing liquidity that you can investors can kind of go in and out over time. You also now have a public currency which you can use from M&A perspective to also expand while conserving cash and aligning interests with kind of other companies and founders you're potentially acquiring. So it has a number of advantages, and it can also be tactical, right? Depending on the specific time, there may be an opportunity where you can tap into the public markets because of low interest rates, because of just high liquidity that may not be available in the private market at times. It can either be because strategically it brings a lot of advantages for the company, or it can be tactically that you found yourself in a time period where either the public markets are more open to you, offer you a higher valuation, offer you more proceeds than potentially what the private market can.
Who is it for? IPO, like, what kind of founders, what kind of companies can go for IPO?
Look, so it varies a lot geography by geography, right? So for example, if you look in the US, it's really for everyone, right? You have biotech companies who effectively just go totally on paper, they go and they kind of list in order to get the money to fund the R&D, etc. And then they either get FDA approval and then kind of the stock flies, or they don't get it, and a lot of times these companies end up shutting down, right? So in the US, really, public markets are for everyone. You've got a kind of a very strong regulator, a very deep market. People understand that kind of public markets don't necessarily mean a company is safer or riskier. It's just a pool of capital, which means that you need to do more extensive disclosure, governance, etc. But at the end, the company can almost be at any stage of its life and still effectively go public, because also you have all types of investors, from micro cap to small cap to mid cap to large cap, etc. In the regions, obviously slightly different, right? Because here, capital markets in general are kind of more dominated by larger cap investors, right? By investors who are looking for more mature companies, larger companies. People see it as a bit of almost lower risk. If the fact that you're a public company, people are also looking for either you to be already paying dividends or have a very short roadmap to dividend distribution. And that's why kind of in the Middle East, you'd see kind of companies potentially going on average public later than you would kind of likewise see in other geographies. Also, historically, regulators have required that you are profitable before you can go public, unlike kind of other markets globally. Now, this is starting to change. For example, now in Saudi with Nemo, with a parallel exchange to Tadawul, you can go public pre-profitability from a regulatory perspective, but still untested, right? No one has actually gone ahead and listed under these rules, because there's still worry that even though regulatory it may be acceptable, from an investor's perspective it's untested, that investors actually be willing to go for it. And that's why in the Middle East, the IPO market remains for kind of more mature companies.
Okay. And how did it started the conversation for Swvl? Did anybody tell you that you are too young to take this decision?
Look, I think yes. I think right, and rightfully so, right? I mean, we've obviously seen the outcome, right? So you can kind of look at it and say yes, of course, the writing was on the wall. You were too young to do that, or you can kind of it's always in hindsight, right? So kind of in hindsight, it would have been, it was like too young. If obviously things went amazing, would have been like, okay, no, I wasn't too young. It was the perfect timing, right? So these things are always in hindsight. It's always a risk that you take, right? But for me, to be honest, the Swvl is less about whether the company was young or not. It's more about the market environment, right? That effectively, like the reason things have become challenging is not that we have gone public at a certain time in terms of our own age. It's more that has to do with how the market, how we went public in a zero interest rate environment that looked very different from what a 6% interest rate environment a very short few months after looked like.
Okay.
And then the impact of that on the company, which then obviously then also partially because of where it is in the life cycle. So if it was purely where the company is in the life cycle, then we have managed that, and that's how we managed to go public in terms of getting all the regulatory approvals, the investments, et cetera, et cetera. But it is the combination of where the company was in its life cycle coupled with such a very kind of heavy, immediate change in markets that we haven't seen in more than 50 years, that rates rise that quickly, that then kind of, given where the company's life cycle, that amplified the impact on that.
Interesting. And what does it cost?
It costs a lot. It costs a lot. So I think obviously depending, it kind of it varies by a lot of things, but at a bare minimum, it would cost a few million dollars to kind of to go public. It would also cost on an ongoing basis anywhere again between hundreds of thousands and millions of dollars per year. And the initial cost we talked about can be a few million, but can even be potentially, like, again, obviously for a larger company, can potentially be tens of millions, right? Because obviously you've got investment banks, regulators, the exchange itself, a ton of lawyers, accountants. You've got obviously all types of diligence being done on you on all countries where you operate. So you've got so many like advisors, diligence providers, etc., involved in the process. Because obviously, again, the idea is ultimately you are selling to retail investors. And retail investors are ultimately looking for the regulator to protect them, to make sure that the company has gone through proper kind of due diligence and process. And obviously the regulator is kind of looking back at kind of all of these advisors involved to basically make sure that the prospectus and the filings of the company reflect all of that. So it's quite expensive. And this is one of the main, if you think about, okay, why people may decide not to go public, right? Obviously, a big part of it is the cost, right? The cost is quite significant. And obviously, overall scrutiny, right? That now that you have a live share price, you have kind of quarterly results, you have constant updates. So you have an overall level of public scrutiny, regulatory scrutiny, public kind of just scrutiny from investors, from people in general. It is very extensive. So then the decision becomes, okay, are the public markets in terms of the advantages we discussed, like liquidity, depth of capital, branding, public currency, etc. Does all of that kind of outweigh these significant costs or not?
Yes, and there is a lot of risk associated with it, right?
Does
it slow down the growth of the company once you go for an IPO?
Look, so I think so. Yes, so I think there's like competing considerations, right? On one hand, from a management time perspective and a focus and attention, obviously the listing process is an extremely heavy and time-consuming process, right? So from your own time allocation perspective, yes, of course, that will have a consideration in terms of the amount of time you can spend on this. But on the other hand, the IPO also creates so much momentum internally because now everyone is working towards one goal, right? Which is we're listing on that specific date. We're going to be releasing results. We're going to be releasing quarterly results. So it also creates so much drive and momentum. And generally, there's so much excitement. There is so much commitment because now everyone feels, okay, now like we're part of this. We have these deadlines. We have this market perception. Everyone is looking at us. So generally aligns everyone to run. And now there's like almost this one North Star, which is the kind of value maximization for these public shareholders. So that also can act as a big catalyst because now all my product roadmaps, my tech roadmaps, my commercial roadmaps, all of them have to be like, okay, what are we delivering this quarter? Because we've got quarterly results to put out, right? So yes, the challenge is definitely balancing attention and focus and not losing focus on the business itself. But it can be quite a catalyst from aligning interests, motivating people, setting kind of hard deadlines, and bringing everyone together on kind of a very clear mission.
And how does it work? Like now, let's say you're going for an IPO. Who can afford this? What range you would suggest? Like
yeah. Look, so I think if you want kind of just sometimes kind of a rule of thumb, right? People say, okay, $1 billion value company is a good kind of just very high level metric, right? Because typically what you would do is you would list around 30% of the company plus minus as a free float on day one. If you're a kind of, let's say, in that size, obviously, if you're a much larger company, you typically go with a smaller IPO. But let's say if you're kind of in that kind of, call it small mid cap size, and a $300 million free float, i.e., kind of this 30% which is available on the market, is a good size to allow for good liquidity on the market. Right? So today, generally, for example, investors would want to see at least $10 million being traded per day, right, for that stock to be liquid, for them to be able to build positions and come in and come out quite quickly. So for the $300 million plus free float, you're able to create this $10 million plus liquidity. And hence you're able to kind of to attract investors. You're also able to start becoming part of like a global indices, which basically drives some of the passive flows, the people who track these indices and just invest in the index to come and invest, etc. So generally, if you want, this is a very kind of rough mark. Does not prevent obviously kind of smaller companies from going in, but that's kind of a very back of the envelope number.
Yes, and I see one of the challenges that you see in the region, especially, right?
Yeah.
See, if you look at other markets like Asian markets, they have SMB exchanges.
Yes.
Which you can list your company in a very low cost, and also you can scale it up from there, right? So you get access to pools for these mid-sized companies, and you see the kind of contribution they make it to the GDP is massive. Look at China, for example, right? The whole economy was driven by SMB markets, right? They just exploded at some point because of SMB lending and access to capital. Absolutely. So what do you see the gaps in this region, especially when it comes to, listing IPOs or, going the smaller companies for IPOs?
Yeah, no, absolutely. I mean, the SMEs are the backbone of, I think, any economy in the world. You're absolutely right, and that's the growth catalyst. And we're seeing countries like, for example, Saudi was the whole point of establishing NMO, right? That kind of parallel exchange to the Tadawul, where you kind of you can report once a year instead of potentially once every quarter, lower listing fees, lesser requirements kind of overall. But then on the other hand, what they do to protect investors is then it becomes less available for retail investors, right? So it becomes more focused on qualified investors, on institutions, because, okay, now I'll give you smaller companies with potentially less maturities, but basically I give it to people who have the ability to do more diligence as opposed to kind of to the retail. So that's kind of, let's say, the compromise that we're seeing a bit in the region. And then, for example, let's say we have Jahez now, which is listed on NMO, and then at some point they'll move to the Tadawul, and this will probably be the first example of a full cycle where a smaller or a tech business has first joined, let's say, that parallel exchange, and then kind of, if you want, almost graduated into the full exchange, and then kind of other companies can follow with that. I think with the UAE, you see that to some extent with kind of Nasdaq Dubai, a lot of the ADGM efforts which are happening now. So I think you're absolutely right that we'll probably continue to see more of these parallel exchanges and small exchanges, SMBs exchanges rising, and it's obviously to support on one hand SMBs, but also support bringing a lot of the financial instruments which we don't have today, right? So today, or we don't have as extensively today, right? So also the advantage of these exchanges is then you start focusing as well on bond, on sukuks, on derivatives, on futures, on all sorts of different instruments that you can also, that maybe the main exchanges aren't kind of, they already have a lot of like stocks issues to focus on, but the parallel exchanges can focus on being a home for a lot of these other alternative instruments to generally increase the market. Obviously, the other markets also have some of the advantages that their OTC market, their over-the-counter market is also more developed, right? And this allows even like pink sheet stocks, even smaller stocks than the SMBs to trade, allows private companies, allows people to exchange shares, options in like private companies. And that is the other big push I think that we will probably see here over time, because as well to start creating liquidity in private companies, not only liquidity in public companies.
What is the major bottleneck that we have in the region in terms of achieving this? Right.
Yeah, I think it's an evolution, right? Like I think ultimately, obviously, like you compared a great example with China, right? I think it's just ahead in the journey, right? Like they've gone through this kind of inflection point where just the market size is bigger. They've been at this for longer. The markets have developed so much. So I think it is a trajectory. So you start obviously always with, okay, how do I make my flagship exchange more liquid, right? So for example, today the Saudi has obviously kind of part of their Vision 2030 is again to make Tadawul one of the kind of largest exchanges in the world, right? So it starts kind of at that top of, okay, I want my large cap and my mid cap kind of really exchange to be as powerful and as big as possible, right? And that's why you see a massive drive from the governments here for as many companies as possible to list, right? If you look at the UAE and Saudi and you look at the IPOs in the last 2-3 years, where basically where the global markets have actually massively slowed down especially like now things have picked up again globally, but if you go 6 months back, there was almost a year from like mid-22 to mid-23 where there was very limited IPO global activity. And in the Middle East, you get an IPO every week in the UAE or in Saudi, right? So that's kind of the first part of the push, which is first getting government businesses, big family-owned business, etc., to be live on the main exchange. Obviously, by definition, that will always be the priority for investors because that's where bigger companies, where dividends are etc. But then, kind of as you advance this, and at the end of the day, you have a finite number of large companies to put on large exchanges. So as this activity will have to at some point start slowing down, then that creates this massive opportunity. Okay, my next part of the evolution is to kind of push through my SMBs into the exchange on, let's say, that kind of parallel exchange, right? And again, at some point, all of that kind of pent demand of unlisted companies, once it goes through, then you go to say, okay, now I want to create the next level of liquidity. I want to create them private companies in over the counter. So I think it's that evolution. We're seeing it start over the last couple of years very strongly in the main exchanges. Like if you go a few years back, the IPOs were kind of few and far between, right? So I think that journey is starting with the visions that kind of the different countries in the region have with their programs, with their sovereign wealth funds, with their exchanges, and then it will kind of trickle down through the different exchanges.
Okay. See, whenever I listen to you, I always see that there's a sea of knowledge that's not out there about IPOs and different markets. So how did you learn all of this? What's your story like?
Look,
I'm always curious to know because we are almost at same age. So I'm always curious to know how what's your learning process looks like. What's your trajectory? What's your
absolutely. And I want to know yours as well because I really look up to you and everything great that you're doing. So I think I think I'm just kind of obviously being fortunate enough to be through as many experiences possible because I think at the end of the day it's really kind of you learn by kind of just being through in as many situations as possible and then speaking to people and having as many conversations as this as possible to kind of to learn from, right? So I think I've just kind of been very fortunate and very, very privileged to have kind of worked on kind of the investment banking side on like very extensive kind of just kind of deal flow, and then kind of as I transitioned also to, let's say, to the tech side, the corporate tech, the corporate side in general. And I think we've also all beneficiaries of what the region has been going through in the last few years, right? That if you think about the region in the last kind of since all of the transformations have been happening over the last 7-10 years, it's been really, really active, right? It's been really active in terms of, again, if you probably take 10 years back, the deal flow was mostly about sovereign wealth funds from here, investing in assets outside, right? And it's a great experience, but at the end of the day, it's one type of experience, right? But if you compare it to what has happened over the last 7 to 10 years, it's now bringing a ton of foreign capital, private equity, infrastructure funds, VCs coming and investing inside the country. It's basically companies from here listing both in country and outside. It's a lot of consolidations and M&A, both kind of here to international, but also kind of local to local and regional to regional. It's obviously a ton of kind of restructurings, whether financial restructurings, operational restructurings, as obviously we've gone through as well a couple of oil price shocks kind of in 2015, 16, and then again in 2020. And obviously these oil price shocks have had their own impact on government finances, etc. So we've gone through kind of 2 cycles of very kind of strong shocks. And then we've got obviously through this whole kind of interest rate massive where kind of we've operated in a 2020, 2021 environment with kind of where there was a kind of a massive experience in how do you fundraise, how do you storytell, how do you run, how do you grow, etc. To kind of 2022, 2023 coming in, the interest rates going where they went, and then kind of a massive learning on restructuring, on cost optimization, on runway extension, on bridges, etc. And hence I think we've just kind of in the last 7-10 years, whether because of the region transformation, whether because of the global events and shocks we've gone through, there was just so much to kind of be involved in, and that ultimately what creates these experiences.
Very interesting. And also, like, so how did you start the journey, and how did you end up in Swvl, and what are you doing now?
I've always been very fortunate. So when I was in university, I took a business writing course in which I had to kind of do a simulation for an application for an internship. I kind of chose that to be Q Invest out of Doha, which is a government-owned investment bank there. Off the back of the business course, I actually applied for the internship, got the internship. Off the back of the internship, they were generous enough to give me a full-time offer. There, I've done a ton of private debt investments and private credit. So when Moelis, which is a kind of a US-based investment bank, kind of they needed someone for the restructuring side in their Dubai office for MENA. I transitioned there in 2016, and then we got extremely fortunate that Moelis was awarded to be the lead advisor on both the Aramco IPO and the Abu Dhabi National Oil Company privatization program, which is basically by far the 2 biggest clients, institutions, and transformation kind of projects happening in the region. So kind of spend time on that, and then off the back of all the Kareem capital raising and sales. Investment banks in the region started kind of getting interest in tech. Thankfully, also I love like Egyptian founders and etc. Obviously, one of the most brilliant out of them, if not the most brilliant, was Mustafa, the founder of Swvl. So I was capital raising for him out of Mollus.
Okay.
Where I kind of started covering technology as well, and then kind of as we went through the D-SPAC, I kind of joined him kind of full time and transitioned my Mollus role into like an advisory role. And then earlier this year, the national company of the UAE, ADNOC, was always kind of one of the main clients I've had on the Mollus side, again as part of the advisory work. So I ended up joining them in a couple of capacities. First as CFO of AIQ, which is the AI subsidiary, and then later ADNOC Drilling, which is the oil field subsidiary. So I think I've always been very fortunate that it was a continued journey with the people I've kind of met and worked with. And
I think a lot of dynamics from investment banking into tech startup CFO to now to being a CFO for a corporate. How do you see the changes? And
look, I think one is the fundamental skill set. It's the same, right? Ultimately, regardless of whether you're sitting in a bank or a startup or a corporate, what is it, right? It's capital markets, it's M&A, it's kind of research and research coverage and kind of getting the right research on the company. It is obviously kind of financial kind of overall from overall finance if you want. So you just do it in different capacities. But ultimately, the core skill set is the same, right? And whether it was trying to support kind of take companies public from Mollus, or taking Swvl public on the inside, or being an ADNOC in an already public company, a lot of the skill set kind of revolves around that, right? Around the regulators, investors, research analysts, financial media, just public investing community in general, right? Same on, for example, when I was with Mollus, you do a ton of kind of restructuring on the advisory capacity. Then if you're in-house, you're also kind of implementing your own organizational financial kind of restructurings, etc. So ultimately, like for me, the core skill set is you have good days, right? Where you are driving growth, valuation, storytelling, fundraising, investors, research analysts, getting the right recommendation. And then you have a skill set related to kind of down days where you are focused on restructuring, runway extension, kind of company preservation, turnarounds, etc. And these are ultimately the two core skill sets, which are constantly applied in different ways, but ultimately there's the same skill set.
And I just want to ask you, like, why finance for Youssef?
Look, again, I think it's just like I studied actuarial science, which is like as close as kind of financial mathematics if you want. I studied it because my mom was the director of the program, so I felt it was quite an easy choice and was very mathematical, and I kind of liked math, so I did it. And then I kind of got that internship in banking, and it went from there. So to be honest, wasn't necessarily like a very well thought through decision, but it just worked out and was quite nice, so I kept on with it.
You eventually got into that, and then okay,
exactly,
very interesting.
Exactly.
And now I think you are also investing in a lot of startups in the region, right? As an angel investor, I saw some of readings when I search Youssef. It's like this company has got investment, and it has like angel investors like Youssef. So I see this is some of the news. And what's your journey in angel investing, and what is always I wanted to ask the investors in the region, what is an investable company to you?
Yeah, look, I think so obviously these tickets are kind of quite de minimis, right? I think the focus obviously on them is less about the money and more about how you ultimately kind of help create value in these companies, right? And for me, that's usually just kind of a nominal ticket as part of a kind of a gesture, as part of trying to really support on creating value in that, right? Look, I think in terms of invest, I think it also totally depends on the stage, right? I think when you're coming in at that like super early stage, there is ultimately very little data that you can kind of really yet look at, right? So ultimately, when you're investing very early stage, you're really just bridging the company to a level where it can get kind of VCs in, right? And hence the way you think about it, the same way, for example, if you were lending a company a bridge money, right, for like 6 months or 9 months, what do you think about? You think about, okay, how is the company going to raise more permanent loans to repay my debt, right? in the very early stage investing, it's the same thing. We think about, okay, is this company going to get to a place where it's going to get a seed and a Series A? Because I know that the money you're investing in that early stage is not going to get the company to where they ultimately need to be, right? So you're not investing that final round to start thinking, okay, what is my kind of path
Exit,
from there and exit, and what's the company going to do the money? It's more of, okay, can that money get the company to a place where it can raise much more, and then off the back of that can really kind of go all the way, right? Unless again you're investing in a business which just requires a very small amount of money to like break even and run, which is different. But if we're talking about like a startup that will still go through a ton of of capital raising, then you're really thinking, okay, is that company going to be able to raise? Which means, is the story attractive enough for VCs, right? Is it attractive from a market size perspective? Is the market really big enough? Are people gonna care? Is the kind of, does the team bring in a lot of credibility that people will want to kind of sit with them and have that kind of that discussion and want to invest in them, associate with them? Just from a long-term perspective, from an economics perspective, is the market from a take rate perspective, from an extraction perspective, are you going to be able to extract kind of enough money from that? So really, at the beginning, it's about, can they build really the team and attract talent, and is that a team that will bring a lot of talent in that's required to scale? So at the beginning, you're really almost taking a view on the next round rather than on the business as a whole, because you're saying, okay, is that? Obviously, if you're coming in at obviously complete other end, if you're coming in, let's say, with the last round that kind of allows the company to break even or to list, you don't really care about how is the story going to be told to the next person. That's it. That's the end of the story. What you care about is, okay, what's the company going to generate from a free cash flow perspective? Am I going to exit? Am I just going to get dividends? If I get dividends, does the yield make sense? Does the valuation make sense? And obviously, everywhere in the middle, if you want, it's kind of in the middle of that. So that's why a lot of times it's really important for people to kind of demonstrate that ability to be able to go and execute and raise, etc. Because ultimately, no matter how much you believe in the company and in what it's trying to do, unless other people can be convinced and other people can come on board, you're not going to be able to drive it on your own, right? So you need to see that, okay, it's not only that I can click and I can believe, but enough people can come on board, enough people as in investors, as in employment talent, as in clients, etc., to really be able to get to the finish line.
Okay. Now when you ask, like, a lot of founders say that I'm going to hire a finance professional to get me fundraising. So who actually has to raise the funds? What's your advice to founders who are raising funds? And
look, so in terms of who does it, it's really the stage of the company. So obviously at the very beginning, it has to be the founder, because at the end of the day, you're raising off the back of the story, right? It's your story, it's your vision, it's your product, it's your kind of plans, it's your etc. And that, by definition, the founder is the one who is it. As the company gets more mature, etc., and
have more data.
Exactly, it becomes more of data driven. It becomes more of, okay, this is really, becomes more execution, becomes more process, becomes more. Then that kind of where where that fundraising effort can shift more to someone on the finance side, on the data side, on the process side, who will focus more on, okay, creating a process, creating the right competitive tension in the process, creating the right term. Also, the terms as you transition from, okay, I'm raising on safes to I'm raising on complex kind of instruments with warrants, with anti-dilutions, with different classes of shares, with different liquidations, etc. Then kind of that is where, with a lot of governance rights, that's where the process starts to transition, because the negotiation process itself becomes kind of more structured in nature. The story becomes much more data-driven. Exit starts to come in. Liquidity considerations start to come in. So that's where the process starts to kind of to transition a bit. In terms of hiring, I think my personal perspective is at the beginning, you'd always put every dollar you have into product, into marketing, into revenue generation, right? Because ultimately you're building the business, and then all the support functions, whether it's kind of finance and everything else that's support and enablement, that comes kind of later throughout the process, right? And at the beginning, you can outsource, you can get advice, you can get part-time, etc. But your core full-time team where you're spending the money is in your core functions, and you outsource, etc. You really try to get the best buck for your money on other things. And then obviously, as you scale up and as you get closer to these, you want to start transitioning the fundraising, you want to start building obviously proper governance controls. The amounts are bigger, the risk is bigger, you want to risk manage, leakages can potentially be more damaging for the business, etc., etc. Then that's where it starts to make sense to kind of build in-house kind of full-time.
Yes. And how do you see then? What is the right stage? Like, is it at Series A, B? What's the right time to bring a CFO
Yeah, look, I think it really depends because obviously the terminology as well. So like we've seen like what was probably an A back in 2021 is probably a C now, and like vice versa. So I think things change, but I think it is that point in time where what are the triggers, right? One is, as we discussed, the transition of the fundraising. That now, okay, you see that the discussions with investors are no longer about the story and about the vision. They're really about the pathway, the economics, the numbers, the process, the execution, the exit, the liquidity, the structuring of the cap table, the structuring of the round. Then that's kind of what one thing you see. When you see that now you're starting to have real leakages in the business, right? So you're starting to see that, okay, there are lots of places where optimizations are really needed, right? So that kind of becomes another catalyst. As you feel that you start to need systems, that people have gone out, that things are starting to go out of control, if you're just kind of doing everything just kind of manual and haphazard, and you want processes and controls and procedures in place. As obviously you start going multi-country, and then you really need to be able to have kind of central systems that you can kind of cascade down. Same if you start going multi-product or kind of multi-business line. So yes, I think you perfectly highlighted the bookends, right? It's probably the absolute earliest is the A, and probably the absolute latest is the C, and maybe probably the B is kind of where you see kind of probably the most, let's say, kind of median, if you want, almost of creating this. But it kind of down really to kind of these specific factors.
And now, generally, like what when you see finance CFOs are different levels, right? Like, what kind of CFO are you in terms of expertise and?
Yeah, look. So for me, ultimately, you have to own the entire thing, right? And ultimately, yes, people will come from different backgrounds because no one will be able to become an expert on everything, right? So you may have someone who comes from more an accounting background, the finance background, the strategy background, the stratfin background. But ultimately, the role everyone will end up playing is there becomes a few things which you have really kind of done extensively, right? So for example, okay, you come from a banking background, so you've done a ton of like M&A and capital markets, right? Or you come from a controllership function, so you've done a ton of like FinOps and etc.
Yes.
But ultimately, the role becomes the same, is that you have to own the entire outcome end to end, because all of these things are interrelated, right? Like you cannot fundraise if you don't really have your house in order in terms of numbers and own them and take accountability for that, right? And you cannot like, again, kind of say, okay, I'm gonna like be on the strategic side and build a strategy without really kind of having the kind of the ability to go down and drill and basically turn that strategy into a strategy ops and execute on it. So for me, ultimately, that's why I personally just prefer that kind of plain vanilla CFO title without like trying to like add different things to it, etc. Because I feel like you've got to own it. And in my mind, there isn't boring and interesting. Ultimately, it's about the outcome, right? And again, if we take the listing as an outcome, in order for you to be public, you need to have, in the US, you need to have your POCB audit from financial statements. You need to be SOX compliant. You need to have, so you cannot, ultimately it's about the outcome. And the outcome, yes, if in order to be public, you need the investor money, but you need the regulatory approval, right? You need the SEC approval. And actually the SEC cares about these things, right? You need to have them. So for me, I've got to own it. Now, ultimately, yes, you'll end up spending more of you will have almost a bit like individual contributor role on specific things. And then you will work with the team and kind of take ownership on other things. But ultimately, as long as you can get to this place, it kind of, for me, it's okay. Like it doesn't have to be that, okay, the CFO has to come from a specific background, as long as they can own the whole thing end to end.
Very interesting. And also I mostly notice, when it comes to valuations, right? You say you are at the right time in the right market, so you go for a higher valuation, and then you see a blow down to the investor at some point. So from your perspective, what do you see, like always overvaluation or undervaluation? How do you see this?
Look, I think people will have different perspectives on this, right? So I think some people will say, I don't want to have, I care so much about not having a down round, right? Because having a down round creates a lot of optical issues. People are like, what's wrong with the company? Have they underperformed? What's happening? Second is obviously if your documentation itself has like anti-dilutions and ratchets and things like that, if you start doing a down round, you can end up resetting your previous valuations, so it can become quite problematic. Your stock options that you granted for employees who joined at the time of the high valuation become out of the money, so then they're either unmotivated or you have to reset these. So there are different challenges, right? So if you like care a lot about these challenges, then the view is going to be, you know what, let me make sure that even if I can get an investor at a higher valuation, let me get them at a valuation I believe I can grow from in the next round to make sure I have the sustainable increase in value, right? You have another kind of thought which basically says, look, no one knows what's going to happen in the future. I have a fiduciary duty to my investors today to minimize dilution, right? So today I will get the absolute maximum valuation I can to make sure that whether that primary capital I'm raising is at a minimum dilution, or if I'm creating a secondary transaction as well off the back of it, I can allow my shareholders to sell at the highest possible value, right? And then I'll worry about the next round and how I catch up to this valuation, right? And again, the problem with these things, all of these things will be in hindsight, right? If the market serves you and you execute well, etc., then people are going to say, yeah, amazing, he pushed to the absolute last dollar and he got me the money and he made sure I got the minimal dilution. If things turn around, it's going to be like, yeah, you know what, the valuation was completely unrealistic in the first place, and so on. And the other way around, right? So for me, ultimately, you make a judgment call, you weigh these balances. But I think if you want like almost a kind of a plain vanilla, I think if you don't have anti-ratchets, anti-dilutions, etc., then you should just try to maximize value, because even if your value comes down, it doesn't hurt you contractually. Yes, there are some optical things, but you can manage around that. But if your round has a lot of things built in that will reset once the valuation comes down, then there's almost no point, because it's like a synthetically high valuation that you know will ultimately come down and then will create kind of these problems.
And at some point, I noticed that you're saying that Swvl is present in 20 countries, 100 cities, right? Massive scale, a company from this region.
Yeah.
So how do you what's your playbook for scaling? And I'm always look at that kind of scaling as it's called Blitzscaling, and it's something regionally very challenging, because if you look at Saudi, it has its own culture, Egypt has its own culture, Kuwait has its own culture. Even if you look at Kareem, some of their expansions have failed. So as a CFO, how do you make sure that the bottom line is always strong? And how do you whole strategies? How do you build a playbook in this region to scale?
Yeah, look, ultimately, there is kind of no free lunch, right? It is a trade-off. So if you blitz scale, by definition, the economics will be weaker, and there's no way around it, right? And like when again, like the blitz scaling comes from like blitzing, which again, where you also stretch your supply chains, and it has its implication, right? So by definition, but ultimately, I think maybe the step before, like etc., is why do you do it, and should you do it or not? And again, it's really a company by company, right? If, for example, you have a competitor who is expanding and who's gaining a stronghold, and if you're in a market where it's a winner takes all and it's very difficult to operate as a second, then you almost find yourself in a place where potentially, even if you know the risks of doing it, you'd still do it because you need the position, right? If you have, let's say, money which gets triggered by certain milestones, etc., so you potentially kind of need to do it if you need to. If you, for example, are in markets which have specific macro risks or geopolitical risks, or your currency is declining and you want to get out of them as quickly as possible, because otherwise you're sitting duck in these markets, then you do it, right? On the other hand, if you're sitting there, you're in a comfortable market, that's why, for example, if you look at kind of companies in the US or in China, they wouldn't necessarily rush to go out and just say we're in as many countries, right? Because they're sitting in a market which is huge, which has a stable currency, has a relatively stable regulatory environment, etc., etc. So why go outside? They will say all the conventional arguments about I want to maintain focus, I want to make sure I don't overstretch my team, etc. So, and in my mind, like at the end of the day, like everyone would know these, right? Like these are not like. Yes, of course, everyone would know that I'd rather like maintain focus and not overstretch the team and get my first market fixed first and then go outside, etc. But it's all really at the end depends on that kind of risk-reward decision you take, right? Obviously, if you decide that, okay, whether it's for competition reasons, for capital reasons, for diversification reasons, for issues with your home market from a regulatory or a macro perspective or a currency perspective, that you do want to go outside kind of very, 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 very rapidly. I think generally you have kind of two playbooks that people use or a hybrid of, right? You have just the market launch squad playbook, right, where you just establish a market launch squad. This is a lot of time constituted of people who have launched your first market or have launched your stronger market, and these guys become a market launch squad. They land in a country from scratch. They build that 0 to 1. They hire the right team, and then that team takes it from 1 to 10, and they go take another market from 0 to 1. So that's if you're on the kind of organic city to city kind of playbook. And then the other playbook is the M&A playbook, whether it's acquisitions, acqui-hires, etc. But it's basically saying, okay, I don't really know that market that well. Instead of taking the risk of hiring the wrong people, of waiting for licenses, of having competition, etc., I'll just basically go and acquire a team or acquire a team or poach a team, etc., in every country or city I'm going to. And then effectively I will equip them over time and I'll do integration over time to equip them, etc. But they own the market and ultimately I become more of an enablement function for them. Or obviously you can do a combination of the two approaches, but these are generally kind of the two ways to approach it.
And from a finance perspective, because you own the risk
Yes.
of the company, right? You're responsible for the risk management, and you're also responsible for making sure that the bottlenecks or there's right ROI from this investment.
Yes.
So what is your finance playbook to look at this massive scaling, right?
Yes. I think the most important thing is ultimately when you define risk is to include all the risks in it, right? So yes, on one hand, if I'm expanding today, I have a risk of failed market launch, risk of unit economics not working, regulatory risk, etc. But also it's very important that equally when you launch, if you're also considering not launching, is to also include other risks, which is a risk of losing momentum, of not growing fast enough, of my home market declining, etc. And then making a decision, right? Because sometimes the challenge becomes is you see so many risks in terms of like expanding or making a decision going outside that's okay, let me not do it. But there's an omission of the underlying inherent risks of not taking these decisions, right? So for example, if I have today a finite amount of runway, right? The minute I'm launching a market, I am taking a risk that I'm reducing my runway, right?
Yes.
But also if I don't launch a market and I don't grow, I'm running a risk that I'm not building enough momentum and growth during the time I have money. So if I reach the end of this longer period, because I haven't launched, I have more money, but when I reach the end of this potentially longer period, I may have nothing to show for it and may more difficult. So maybe I'd rather be forced to raise in a fewer months, but be forced to raise with better numbers than have the luxury of waiting for longer, but I will run out of money still at some point unless I'm solving all the way to profitability. And then what do I do then? And even, by the way, if I'm solving all the way to profitability, I also run the risk that I reach profitability, but I'm not in a big enough position to be able to scale. So it's just balancing all of these risks.
And what are your learnings like now? The valuation of Swvl has came down, right? And what are the things that you learned after that?
I think the thing you learn is that the things can really go wrong and the market can turn much faster than you expect, right? And that really doomsday scenario and tail events, etc., do happen, right? So you bake in, you say, okay, by the way, I know that this 2020, 2021 environment will not last, but as it comes down, I expect it to come down with a certain cadence, right? I expect rates to rise with a certain cadence, but things can happen. Like you can end up with a severe devaluation, with a hyperinflation, with a war, and with an interest rate increase all happening at the same time. It can happen. Yes, things can all go wrong at the same time, and the importance of planning for all of these things going wrong, as opposed to planning maybe for only reasons outside. Now, would this planning change the decision you make? Maybe yes, maybe no. Like at the end of the day, it's a function of risk appetite, right? And it's a function of the alternative. You may say, you know what? Yes, there is a scenario that looks very drastic, but that scenario has a 5%, 10% probability, and I'm willing to take it because at the end of the day, in 90% of the cases, I end up driving that much. And that's absolutely fine, and that becomes a decision to make, and you own that decision, right? And then obviously, if you end up in that 5-10% scenario, then etc. But it's just the importance of really making sure that it's extremely well understood how this can play out in all scenarios. And there's absolutely nothing wrong in one person saying, I can't take this 10% risk. I'd rather slow down, even if that means I'm missing out in 90%. And someone else will say, no, I want to solve for success. I want to go all in. I want to make sure I'm much more successful with a 90% probability than having a more severe reduction with a 10% probability. And as long as we're looking at the same facts and everyone understands them, it ultimately becomes a judgment call.
And you have seen such a massive scale for Swvl, right? And why do you think region doesn't have such unicorns and massive companies? And otherwise, what it needs to be done?
Look, so I think obviously the first point is market size, right? I think at the end of the day, like we talk about the region, right? But at the end of the day, they are separate markets, right? They are separate markets with separate, for example, as Swvl, right? As we go market to market, we need a license in every market that we operate in, right? If you are to operate on the B2C, B2B is easier, but on the B2C. Similarly, if you're in a fintech business, if you're in a healthcare business, if you're in any regulated business, you need a license in every one of these 22 markets that we call the region, right? as opposed to someone operating in the US or operating in China, operating in India, who's already operating in a market that 10, 20, 30, 40x bigger and does not have or the same level of independent kind of regulation. So that's just kind of a reality. And obviously, the first stepping stone towards you like going global is for you to have your own home market big enough to be able to build massive scale and profitability in it to fund your international expansions, right? And that's why, by definition, you will see that the biggest global businesses, whether coming out of the US, China, etc., are the ones who have the biggest home markets that then they're able to build on and go global. So this is something I think just outside of everyone's control, right? What can be done about it? Of course, closer regional, like removal of regional barriers is by definition the biggest help there, because at least if you're able to really call the region a market as opposed to multiple different markets, then at least you have that more scale immediately that allows you to kind of to build on it and go outside. So that's kind of one thing. The second thing is also is capital, right? And that's we're seeing more and more. So now we're seeing more and more sovereign wealth funds and different kind of pockets of money backing regional startups and local startups, right? And I think historically, again, if we go 10 years back, what was the main challenges is a lot of the money from here was kind of being predominantly invested outside, making it more difficult for companies here to get the capital they need to build these world-class products that can go global. Now that's changing with so many kind of governments and sovereign wealth funds and just investors in general having that mandate to kind of support out of here. And then obviously you need the entire kind of enablement around that, right? So how do Chinese companies, whether tech or non-tech, become so successful outside China? Because you have that massive push, right? Once you kind of go outside and land the contract, you also bring so much of your economic kind of ecosystem with you, etc. So it really requires that drive, right? That as one company goes outside, it brings another company with it. It brings an import kind of a development bank with it, an export credit agency with it, etc. So you have that push to support these levels of, okay, I do want to export. I want to export technology. I want to export products, and I want my companies to go global, and I will do everything I can to basically support that from an overall economic perspective.
Very interesting. Very interesting. I think something that we can look up to Europe. It's a very small fractional market, but very consolidated, right, as a market.
100%. I mean, that's exactly your point. That's the whole concept of like if it wasn't for the EU, and if all of these markets were totally different with different regulations, etc., it probably wouldn't be at all an attractive market for a lot of people to operate in, right? Again, if we take fintech as an example, the fact that today you can get a license and it opens up for you the EU, that's a game changer, right? Imagine if you actually had to go get 20, 30 different licenses. If you think about businesses like Square, like all these businesses that scaled in kind of came from the US to Europe or originated in Europe, they wouldn't necessarily have been able to kind of do that way. So I think that's absolutely a great point.
And how do you see the scale of companies, especially here, if you look at, a lot of tech-enabled services as a businesses, and there is not much lot of deep tech companies. That is also one of the challenges, right? And what do you think can be done for the region to enhance the tech companies or the companies that scale? Because I look at other markets, you are a company that can be scaled, you get funding, right? Here, it's mostly revolves around tech. It's not necessary to be that, right? Even you can be a D2C company, can do like a massive manufacturing and can do the contribution and do an industrialization. So what do you see where things are lacking and what can be done?
Yes, I think that's a few great points here. I think one, if you think about the services side of things, right? Again, if you take a step back from technology, obviously the whole region, you have less sources of capital than you'd have outside. Like, why would a services business or direct-to-consumer business be able to thrive so much outside from a capital raising perspective? You've got so much moods of capital, right? You've got private equity, you've got search funds, you've got just kind of a massive family office investing in all types of business. You've got strategic investors. So almost outside, it doesn't matter where you are in, you will always have a pool of capital which can effectively fund that specific business you're in, right? Here you don't have necessarily the equivalent of that, right? So we, for example, like say, private equity asset class is extremely small in the region, right? Outside, again, the sovereign wealth funds, kind of private equity teams, search funds, we have just kind of barely a few in the region, and that's partially is that because we've had this proliferation in venture capital in the last few years in the region, and it became very hot. As you said, a lot of companies just want to take advantage of that, not necessarily because their preferred mode is that, but because you don't have the same pools of capital in other things. And hence, okay, I have to make it a startup because that's the way to get money. Because if, even though it can be an extremely successful, as you said, services business or an SME or a direct to consumer, but if I don't have the funding avenues for that, then I have to move it into where I have a funding avenue. So it's more, and ultimately here again in the region, because unlike, I mean, again, the main difference in the region and let's say other parts of the world is more other parts of the world where it's more dominated by private capital. It's ultimately pure capitalism, right? The capital will go wherever it is more efficient, right? So if tomorrow 100 people go and create 100 DTC companies which are very successful, even if today there was no DTC pocket of investing, tomorrow there will be, because their success is going to create an asset class that's attractive for people, and capital will immediately move there, right? And that's just because that's how it operates. Right? At least from a Western perspective. When you come to the Middle East, obviously the majority of the capital is government controlled capital, right? And that capital is not free to just go wherever the opportunity is. Shop, like you don't have an investment shop popping up tomorrow just because this happened. So you need to have a government directive to allocate money towards that, right? And that is by definition a longer process because it's a planned process as opposed to a reactive process that happens very quickly to kind of a market opportunity that's available. And that's why the same way VCs have proliferated in the region by sovereign funds making big allocations to VCs, you need to see these sovereign funds putting more and more. And that's what we're starting to see with things like Vision 2030, etc. Okay, this is within the vision, then let me start allocate capital to things that are within the vision. So that's kind of one part of it. I think also one part of it, it really sometimes depends on the environment, right? When you're in an environment where there's so much money in tech with so much large round sizes, you'll see a lot of focus on, okay, I want to be in the tech space because I can just get so much money from it. If you look at an environment like today, you have a lot of people who are saying, is it really worth it spending all of that money building, let's say, a product or some IP to allow me to raise, which may end up being a small amount, versus having a tech-enabled services business that is, by the way, maybe built on some white-labeled technology, etc. But the services arm is very strong, and that's where the barrier to entry is. Because ultimately, if I'm not going to raise that ton of money anyway, then I might as well conserve my time that I spend fundraising and avoid dilution in the company and actually outsource the tech or get a white label and then build a very, very strong services business that can be very profitable.
Yes, very interesting perspective. I think it's. So I think a lot of things are evolving in the region. It's in the very early stage. I think it will consolidate. I think you will see a massive change maybe next 5-10 years in this region, because the ambition is there, the passion is there, the vision is there. It just need a consolidation, have a lot of conversations. I think the things gonna change. Very optimistic about the market and the companies moving here. How friendly the Middle East is and the economy. Look at Saudi is massive. The kind of growth you can see it in your eyes.
Absolutely.
And out of all this, Youssef, like how do you manage your work life?
I got an amazing.
Because every time when I speak to you, you are all time available.
I've got an amazing wife, Yumna, who takes care of everything and makes sure I have all the time. So yeah, I think that's it.
And how do you manage like a lot of companies, consulting, people are calling you for advices?
Yeah. Look, I think also, yes, when you have obviously more things, by definition, on one hand, it's more time consuming, but I do genuinely believe that you do have this efficiency that creates with the deeper the networks and the relationships and the dialogues you are having, right? Because a lot of, as you said, like take an example of what you mentioned, right? Consulting or trying to problem solve. If you are problem solving with someone and you've had so much insights from seeing other people, you can problem solve much faster. If you're trying to connect someone and unlock a business opportunity for someone and you have a bigger network and you have so many people that you know and that you're working with, you're able to make that intro and that connectivity much, much faster. So I do think, yes, of course, as you kind of engage in more activities, there's an element of a higher time burden of doing that, but you end up doing everything much more efficiently because of the insights and the connectivity you gain. And hence overall you end up being just much more efficient in the way you operate and much more resourceful and able to get to the support you need to provide for something you're doing or for someone else much faster than if you were doing it within a very narrow network and frame of mind.
I think this is one of the things that I observe mostly when you meet some experts, right? They speed you like next 10 years or 15 years. The kind of insights they have is brilliant, and then it changed the whole perspective of how you think.
100%. A lot of these, by the way, a lot of these insights are just relaying back what you hear from other people, right? And that has value in itself, right? Because at the end of the day, like you're never going to be able to have, like at the end of the day, yes, the insights you will have from your own work will always be limited, right, to your own experience. But if you are constantly out there engaging with people, every time you are consulting for someone, you're learning from them as much as they are learning. Yes. And these learnings, you are taking them to someone else. And that's what really amplifies these insights.
And what is your like one like a lot of aspiring finance professionals and a lot of people are looking up to you, and what is your like advice or suggestions to early stage finance professionals and to really be great at what they're doing, and to early stage founders?
Yeah, look, I'm always a bit careful about the advice piece. I think I've had my own share of like things which didn't necessarily go great. So I could have, if I had all figured out, I would have done better myself. But look, I think ultimately it is like in my mind, it doesn't really need to be all pre-planned that, okay, by the way, I'm just going to do kind of X, Y, and Z and get there. I've got all figured out. It's absolutely fine to not have it figured out, but just to try to kind of seize every opportunity that's available out there and open every door, right? Because whether we're talking about a founder who doesn't know kind of necessarily who's going to be the next pocket of money, the next investor, who's going to be the next employee, co-founder, partner, who's going to be the next B2B client, next kind of affiliate or channel partner, and equally for an early kind of person starting in a career who doesn't necessarily know who's going to be their next colleague, who's going to offer them. It's really about creating this connectivity and trust and track record, right? Because that investor will move from a fund to another fund, and that colleague will move to another company. And really, at the end, and that's something for me personally, I've learned, is that it's really about the people that you worked with that you will track record. Because ultimately, always the best chance you have at landing another job, at landing another investor, at landing another client, other than the one you have now, is a person moving. Or is a person part-time that also works somewhere else, or is a person consulting who's somewhere else. Because anyone who's seen you operate and worked with you is always way more likely to hire you, to invest in you, to become your client, than a person that you've just pitched to in an interview or in a meeting or in a pitch, right? And that's why trying to work with as many people as possible and seizing as many opportunities as possible and build a track record and having as many people as possible see you operate and hence get your kind of hand on every project, initiative, transaction you can work on for as many people as possible to be able to work with you and see what you deliver and spread the word and kind of themselves move and use you again in other things is for me the most effective path.
I think it's very, very interesting perspective, because I'm a big fan of relationships, in this social world.
Yes.
Everybody is like trying to be in social media and spending their time there, but it's always a lot of things works on deep connections and relationships.
Yes. And for me, like social media is like everything else. Like ultimately, why are you doing it, right? If you're doing it because, again, it's that exposure is helping you and you are seeing it convert into whatever you are doing, right? So you're a consultant and social media is helping you land more work, etc., then it's absolutely great, right? And it helps. But as you said, it's all about, I'm always doing something because I'm trying to get to this deeper connection. And yes, of course, I need to build that top of the funnel, which is going to come with social media, with events, with networks. And that's all great and has to be done. But as you said, it's all about how do I then kind of take that relationship and deepen it rather than just always keep it at that level, because just having all of these at a very high level is not going to help. What's going to help is you need the top of the funnel, but then how do I convert?
And one last question, like what it looks next 5 years for Youssef and for the region, what do you see?
Look, for the region, I'm very optimistic from an economic perspective. Obviously, kind of our prayers are kind of with our brothers and sisters, obviously in Palestine, with everything that's happening, and hopefully that's a better outlook for them on that side. But from an economic perspective, very positive. As you said, the government transformation projects which are happening across the GCC, across the wider region. I think we're finally at a place where we've got the vision, we've got the execution plans, we've got the funds, we've got the funds behind it, we've got the public-private sector partnerships. So that will continue to create a ton of opportunities. It's yes, sure, maybe today on the tech side specifically, there is potentially less capital available. But again, other sectors of the economy may be doing, and things will turn and opportunities will change. But on the overall region holistically, I think it is very, very positive. I think for me personally, I'll do the same thing I've done for the last 5 years, which is kind of take it as a ghost, try to kind of seize every opportunity I can, speak to every person I can speak to, and open as many doors and see where it gets to.
Awesome. Thank you very much. Thank you very much joining the podcast, Youssef.
Thank you for having me. Such a pleasure.
Awesome.
Thank you.
Thank you so much.